Hi, good afternoon, everybody. Welcome to our session on value investing today. My name is Sean van den Berg. I head up client education at PSG Online. Let's start off with two little questions quickly. How many of you would like to achieve financial freedom? I presume most of you are. Secondly, how many of you would like to be a successful investor like Warren Buffett? I presume most of you also sticking up your hands. Okay. Well, that's what we're going to talk about. We're going to talk about value investing today. First things first, just to type in a little box in the question box that if you can hear me clearly, if I can do a quick sound check before we get started. I really appreciate someone just to type up. Yes, great. Thanks, Leslie. Okay, appreciate it. Great. Thank you, Ryan. Okay. Okay, like we do with every webinar, this presentation is being recorded. So those of you who are on the webinar, you'll be getting the presentation as well as the recording. Obviously, the idea there is for you to do some review, but also obviously any questions you might have, you have my contact details at the end of the webinar to send me any additional questions you might have. Okay, so let's get started. Here's the agenda today. We're going to be focusing on obviously value investing. It's an introduction to value investing. Obviously, future webinars we'll go into more details. So this today just to cover what is value investing, some value investing principles, and just to discuss some of Warren Buffett's strategies. Obviously, he's got like more than 40 years experience and he uses different things and he has evolved over the years. So we're going to just touch on it very briefly today. I just want to whet your appetite to this investment strategy as such. That's my goal today. Okay. So my objective is obviously for you to go onto our website, use the tools available on our website to help you find the shares that are undervalued from a value point of view. Okay, so let's get into the nitty-gritties. A quick introduction to value investing. It's based on an investment model. It was derived from the ideas of two professors at Columbia Business School, Benjamin Graham and David Dodd. You might not have heard of so much David Dodd, but most of you will realize that Benjamin Graham is Warren Buffett's mentor. And some of you might have bought Benjamin Graham's book, The Intelligent Investor, which is regarded as a Bible of value investing. Anyway, these guys started teaching these ideas way back in 1928 and also wrote a text in 1934 called Security Analysis, and just after that, Benjamin Graham wrote his book. But basically, value investing has taken many forms since its inception. Basically, you're looking to buy companies whose shares are undervalued or underpriced using various forms of fundamental analysis. Basically, you're bargain hunting as a value investor, put it bluntly. So you use various criteria. You can either use looking for shares that are trading at a discount to net asset value or tangible net asset value. You're looking for shares that have high dividend yields or a low price to earnings multiple or a low price to NAV ratio. I'm not going to go into too much detail on these ratios today, or I'm not going to go into any detail today. Obviously, that will be for future webinars. I just want to give you the quick umbrella version of what is value investing today. But basically, when it comes to picking shares, it's a defensive investment strategy. Obviously, you're looking for shares that are trading below a tangible net asset value. So this quickly tangible, it's something that you can hold. I can sell a building, I can sell stock and things like that. So things like goodwill and patents and royalties, those things are intangibles. So here we're looking at tangible net asset value. So the main idea is that you're looking to safeguard against adverse price movement or adverse price developments that is often encountered in the stock market. So you're buying a share at a big discount, the share's fallen already, can't go much further. That's the kind of criteria you're looking for, as long as it is still a good quality company. So Benjamin Graham, he always took the position that value investment was the only real form of investment, and his opinion was anything else was speculation. Okay. By the way, as we go along, any questions you guys have, let me know. I'm getting some feedback here from Jacques. Says that the audio is breaking up. Is that true? Anywhere else? Are you hearing me clearly? Okay, maybe just check your connection, Jacques. I'm coming through loud and clear. Okay. Any questions you have, context related? Thanks, Darren. Okay, anything that's context that we're talking along, just pop me a short question. Try and make it short and to the point so we can just cover it quickly. If I don't answer the question, I'll get you the end of the presentation. Alternatively, come back to you with the email. Okay, so let's move on. Okay, so we've been talking about tangible net asset value, but what is net asset value? Net asset value is one of the most useful in industries where, as I say, assets are tangible. As I mentioned just now, intangible assets refers to things like patents, software, brands, and goodwill, and things like that. The challenge of that is it's difficult to quantify. How do you put a value on it? So, you know, if a company's got a lot of intangibles and the company goes to liquidation, it's difficult to quantify, especially when the company becomes insolvent and has to be sold off and things like that. Alternatively, what about companies that are involved in industries where there's fast technological advances? Okay, it's also very difficult to estimate the value of the assets. And we're talking about the IT industry and those kind of things. Alternatively, what about companies that the production asset of production power of an asset is reduced because of competitive innovation? So obviously that can also lead to permanent impairment. So all these sort of things can challenge the industry. So I'm using an example here where you have a personal computer. It's an asset, but it's decreasing over a period of time because obviously technology is improving all the time. So when we talk about NAV, the Americans talk about book value, does not mean just, NAV at the end of the day, if you take the assets minus liabilities divided by the number of shares in issue, that's what we call NAV. If the company only going to liquidation, that's the worst case scenario, what price you get paid out. It might be 30 cents in the rand, whatever the case might be. But it doesn't mean a lot in the services and retail sectors. Obviously, different ways of analyzing those sectors. So when it comes to calculating value, the modern way of doing it is we talk about discounted cash flow, or DCF. Now, you as a small private investor not have the time to go calculate future cash flow, because that's what it is. It's the value of the asset, the sum of the future cash values discounted into today's value. So it's a bit of a thumbsuck, but obviously the big institutions will do those numbers. You and I, small private investors, we use NAV as a ballpark figure. Okay. So let's talk about value investing as a strategy. I mentioned just now, I call it bargain hunting, but basically looking for shares that are trading less than the intrinsic value. Now we spoke about an NAV, net asset value. Intrinsic value, you can very loosely compare it to your NAV. It's the real value of the company. That's what we're talking about. So value investors as such, there's the strategy. We look for companies that they believe the market has undervalued. The market has sold the share off because they think there's no prospects. Okay, I'm just saying that the share price has fallen. But also saying that markets also overreact to the downside as well as to the upside. So obviously the market overreacts to good news and bad news. You saw this week alone. On Monday our market tanked because of Russia hinting of invading Ukraine, and then next minute President Putin says no, he's not, and the markets reverse again. So those are opportunities to get into the market where the market overreacts. Okay, so when this situation does happen, sometimes the price movements do not correspond with the company's long-term fundamentals, and that's where you pick up the bargains. So you can profit from buying when prices are deflated or, as I say, have fallen. The biggest challenge of calculating intrinsic value is that there's no real correct value. There's no real correct intrinsic value. You have two investors look at the same company with the same information, you'll have two different opinions. Okay, you'll have two different valuations on that company. So the central concept, okay, to value investing is what Benjamin Graham termed the margin of safety. You want to buy the company at a big enough discount to allow room for error in your estimation of value. Okay. But saying that, the very definition of value investing is also subjective. And some value investors only look at the present assets and obviously earnings and do not place any value on future growth, where other investors will base strategies completely just around future growth and cash flows. So there's different methodologies, but it all comes down to buying something that's trading less than it's worth. It's the same, remember, you're looking for a bargain. You're looking for something that's worth R5 and it's trading at R2.50. That's the scenario you're looking for. Okay. Excuse me. Okay, let's moving on. Maybe the next slide. Hope you guys are enjoying this. This is a quick overview. Let's talk about some investment principles, value investing principles. There's 9 of them. This is all taken from, I've read quite a few of Warren Buffett's books. Remember, he hasn't written them himself. A lot of people have written about him. But he has some of his principles in a very concise or shortened version, and I do discuss it in one of the tutorials. The idea here, first of all, is follow the progress of individual companies, not the share market. And I'll talk about it again just now. Obviously, Warren Buffett has taken flack on this principle. The challenge is that you're buying into a share, you're not buying into the stock market. So you're do due diligence on the company, you'll know everything about the company. So a regular analysis, obviously keeping up to date with the company's financial reports, you'll be in a situation where you make an informed investment decision. That's what you want to do. So it's not more just thumb sucking, you're just looking at the share price, you want to know everything about the company. What is the company's products, what do they do, etc. Okay. So you also want to have a clear view of the future of the company's prospects. So you want to have a long-term earnings outlook. So obviously that's also very important to your investment decision. So this whole strategy talks about a buy and hold strategy. So the main reason why you want to invest into a company is because of the future cash flow or the expected cash flow coming into the company, okay, and from the share. So you want to choose shares in the best companies. This is the main strategy that Warren Buffett approaches. There, where the share is undervalued, but it's still the best company. When I say best company, you could also say the good quality company. So you look for companies that have a proven excellent track record in the field of business. When I say excellent track record, you're looking for consistency. That's a secret. Consistency year in, year out, and it's sustainable. So you want to look for an increase in profits over a number of years. So you're looking at slow, steady incline. Okay. Warren Buffett says you look for companies in outstanding. You look for outstanding company at a sensible price, rather than a generic company at a bargain price. Okay. So that's just a quote from Warren Buffett. You're looking for a good company at a good price or reasonable price. Identify the actual value of the share. We spoke about it just now. Every company has intrinsic value. So it's calculated by obviously not only taking the NAV, but also taking its earnings power. So obviously you want to buy into companies that, as I say, have prospects, that it's a sustainable business, and it's got a bit of a future. That's what I'll talk about, earnings power. They can carry on doing the operations. This company's not going to go into liquidation, and it's a going concern. So earnings power, I'm looking for sustainability. So you look at things like return on equity to help you estimate the sustainability of the business. And I mentioned just now, you want to hold on to your shares. So this strategy obviously dictates to a buy and hold strategy. And obviously, you want to tie the share. You should only sell the share if there's a better opportunity somewhere else, a better investment at a higher return. But you want to look at a company and look at its future earnings and the trend. If you anticipate that the earnings trend is going to change, and that's going to be the new sustainable trend, then maybe consider selling. So the point is, have reasons for selling. You should never sell a stock just because it's got a higher price. You want to take some profits. Remember, it's an investment strategy, buy and hold. Okay, so that should never be a reason for selling. Let's talk about principle number 6: buy when the price is right. Now you can pay too much for a share. The long-term return on your invested capital is calculated by obviously looking at the relation of your purchase price to its earnings trend of the company. If the price is higher than the earnings trend, obviously the return will be very slim. So you want to buy, as I say, you want to buy that bargain. You want to buy where there's value in that company. It's impossible to cover all your bases, so it doesn't mean just abandoning your conservative or safe approach or just throwing caution to the wind. You don't need a lot of investments. You just need a few investments in excellent companies, and that obviously will dictate your path to success. And obviously, the buy and hold strategy, if I buy once and I don't sell, obviously your brokerage cost is much lower. So avoid making those non-essential transactions. And obviously, all those other transactions and things like that, it also drains your earnings power. And this is also quite contentious. Ignore the experts. You must trust your own instincts. Obviously, that comes with knowledge and experience. Do not rely on the opinions of others. Do your own homework. That's what he's saying here. Least of all, don't look at the stock market as what we call the daily fluctuations in the context of a long-term investment approach. So obviously, you do get a daily noise, and that's where you need to be confident in your stockbroker, in your investment approach. Okay. So let's talk about Warren Buffett, some of his strategies he might use. Let's talk about Warren Buffett himself. He's one of the world's richest individuals. I hope most of you have heard of Warren Buffett. He's worth more than $30 billion. He is the most successful investor. He's the leading investment authority. He's got a track record of more than 40 years. Not only that, but he's also an amazing man. I always find that I found this interesting. He still drives his own car. He still does his own taxes. But he's also a very intelligent and intuitive man, as well as also being a warm and a genuine person. Okay, so he's got that charming things like that. What attracts people to Warren Buffett, obviously, is his investment approach and his ideas. So this buy and hold investment strategy is core to his approach. He doesn't use traditional portfolio management in the sense of looks at share weightings and industry diversification, and he doesn't benchmark anything. He uses portfolio management differently in the sense that, if I had to do a quick analogy, if you had to just restrict his selection process to the companies or the companies based in his hometown of Omaha, his approach would be you first ascertain the long-term prospects of all those different companies. Then you'll whittle it down and look at the quality of those companies, the management rather. And from there, you'll only purchase a few companies, the best companies at reasonable prices. So he's not interested in all the businesses. He doesn't spread the investment risk very wide. And it comes back to what we always talk about, portfolio management, between 8 and 12 shares in your portfolio. You don't need a lot. Okay. So why would this strategy work? So if you had to look at, obviously, he's got the whole world available to him. He's got a universe of companies that's much bigger than the companies that are in his hometown. Why would he behave any differently? So that's his approach. He sticks to his knitting as such. So the idea of buying a good business and holding for several years and obviously matching those returns to the company's prospects is a simple and straightforward approach. And obviously, investors find it quite easy to understand and appreciate this approach. Warren Buffett, as such, has two ways of looking at the market that's attractive to people. He uses a definite buy and hold strategy. And secondly, obviously, this strategy has made him a multi-billionaire. That's why people follow him. Okay. So let's talk about some of his strategies as such. We talk about look at owner earnings. This is a bit of a calculation. It's the net income plus depreciation and amortization. It's a way of writing off like a form of depreciation. There's your capital expenditure and any additional working capital. So this figure is basically the true reflection of the company. So the way earnings are usually reported is only useful if your analysis is close to the expected cash flow of the company. So cash flow, yes, is important, but it's not the perfect tool for measuring value. So obviously it ignores CAPEX. And later on, when we start talking about all the different financial statements, I know that we're talking about income statement in about 2 webinars time. We'll also be talking about cash flow one of these days. So cash flow is not a perfect tool, but that's very important when it comes to manufacturing companies. But the main point here, look at owner earnings. There's a bit more stricter criteria to look at. Look for high profit margins. Looking for companies that are a strong business. A company's management has a tenacious spirit of controlling costs. Those are the companies you want to invest in. You'll get some companies that have high cost operations. The management are careless in the sense that obviously they'll always find ways to increase overhead costs. So you're looking for companies with low cost operations because they're always finding ways to cut expenses. Look at it this way. Every rand spent unwisely deprives you as a shareholder of a rand of profit. Okay, so you're looking for companies that are well run, hence the quality of management. Look at retained earnings. For every rand retained out of earnings, and others we reinvest it back, remember it's a source of capital, and plow back into the company. Obviously, you can get that money to work for you again. You'll see that improved in the share price. Okay, because obviously the money's working for you now. Warren Buffett also contentious. He says, combined value and the growth strategies in the market. There's always been a debate. There's two different strategies. He says it's nonsense. Basically, the two strategies are joined at the hip. Value investing, he says, is estimating cash flows expected over a period of time, and obviously value growth is basically just a simple calculation to determine value. So he says it's the same thing. You look at growth and value together. And later on in future webinars, we talk about the PEG ratio, basically tax that into consideration. Okay. So the share price should increase or at least match the growth of retained earnings over a period of time. That's another little benchmark you can use. Let's focus on 4 or 5 year averages. You're not only looking at this year compared to last year, you're looking at a longer term trend. So obviously, you get a better picture of the market. Stick to the simple and stable. You want to avoid companies that complicated to understand. He doesn't buy into any IT companies. He doesn't understand companies. So you want to look into companies that have a tangible net asset value. You want to buy into companies that there's a substantial margin of safety, and this will help you determine your value. Okay. And as I mentioned just now, point number 7, ignore the stock market trends. This is one of his most controversial subjects. Principles. He says that a savvy investor can do much better than most institutional investors, but obviously by just doing the numbers and things like that. He doesn't care what the stock market is doing. He's looking at individual companies. He bought Coca-Cola after it had already risen a 5-fold in over a 6-year period. So got up 5 times, 500%, and obviously then he gets involved in the market. I always bring up the case of Naspers. Naspers, yes, it's a great growth company, but it's not a value company. At the end of the day, 85% of the business is Tencent Holdings in Hong Kong. So it's a very difficult share to buy into from a value point of view. And then point number 8, be extremely selective in your share process. And this is where the website is handy to use. We use the value filter and the quality filter to whittle down the list of shares to a more manageable list. And from there you can do further analysis. But he says, you only need about 5 companies. And those 5 companies account for more than 75% of his investment share portfolio. So it's a handful of stocks. He doesn't use diversification. Obviously, you don't put all your eggs in one basket. You want to diversify it. He's talking about 5 companies. So, which is the good news for us. How many of you feel that you don't have enough time to invest? All you need to do now is find 5 companies. So that's your focus as such. What's important is obviously making a correct decision at the right time. Of his 40-year career path, he says just 12 investment decisions have made all the difference in his share portfolio. So that's quite interesting. Do not buy the share unless all the facts are in your favor. Obviously doing your homework again. I'm going through this very quickly. And then obviously you have the cash ready to snap up bargains. So don't be fully invested all the time, especially when the market's falling. You want to have some cash available, and that's where you pick up the bargains, and that's how you make the money. Okay. So obviously I'm going through this thing fast. I'll tackle some other stuff just now. Any questions you guys have? Let me see, everything's going through at the moment. Oh, here's a big question. Can you use a big question? Yeah. Wow. Try and keep the questions short and to the point. Where's this question from? Wow. Millions of questions here, and one from one person. Okay, Neil, yes, the PowerPoint question of the presentation will be sent to you. Yes. What better perform better than any other year? Right? What perform better? Listed companies or unlisted companies? Wow, that's a difficult one. How do you quantify unlisted companies? Difficult one to answer that one. Sorry, I don't know how to answer that question. Which would be better, listed companies or unlisted? Sorry. Okay, sorry, these questions are very long, people. Keep them short and true. Just come to the point. Very long question here. I'll have to answer that question afterwards. 5, 6 lines. PHG on website, how do you access it? Obviously, you can register. If you've got an account with PHG, you can register as a free trial, and that gives you opportunity to test this out. You'll have access to all the research tools on our website. You can see our trading platform, also, as I say, the research tools. 30-day free trial, and after 30 days, obviously, you can open up an account with us, equity account. Won't cost you any money at the beginning. It's going to cost you 40 Rand a month. You have to start trading straight away. But you can use the investment tools, or the research tools as such. Okay. Just keep the questions short and to the point. Those long questions, I'll have to come back afterwards. Sorry about that. As I say, private investors can do much better than professionals. And point number 14, I found this was interesting. Warren Buffett does not like mining or farm-related companies. Yeah, he rather buys the output. I found that was quite fascinating. You'll never buy into a gold share. You'll rather go buy gold bullion, like the ETF New Gold. That little quote from him says the company spends $1 billion to extract some commodity, and then it has to reinvest much of its profits in more development facilities. Eventually, the consumers have forgotten the metal, and the company is left with a big hole in the ground. He looks at it this way: you take the money, you take the gold out of the ground, the gold ore, melt it down, make gold bars, and then put it back in the safe underground and put something to guard it. There's no real value on that. So he doesn't like gold shares, and you're going to be ending up with a hole. Alternative, also, he doesn't like farm-related shares, because he says you're going to look at basically supporting a company that just keeps on eating money. You know, you have to keep paying taxes and end up with debtors. So that was quite interesting. Obviously, he buys into companies he understands. So there's a whole universe of shares that you can exclude from that analysis. Okay. I just want to throw this in quickly. 6 qualities. This is from Warren Buffett again. You must be innovated by controlled greed and fascinated by the investment process. If there's too much greed will control you, but too little will fail to motivate you. So you have to find the balance. When it comes to trading, we talk about being objective. That's putting yourself right in the middle between greed and fear. So the same scenario here. You have to be patient, especially for buy and hold strategy, especially in value investing. You want to buy into a company you want to hold permanently. Not because just because the price goes up, you don't want to sell. You want to think independently, as I said just now. Do your homework, and obviously you have to be self-confident when it comes to your knowledge and things like that. Not just be rash and any thing happens in the market, you're spooked. And obviously accept when you don't know everything or know something. That's what I do. I'm always continuously learning, and as I learn, I apply, and then I gain experience, and I review it, and then I learn again, and this goes on. We're also saying at point number 6, be flexible as the types of business you buy. We're talking about value investing. We understand that obviously most industrial companies will fit this bill. We understand that banking stocks are a different way to analyze. Same with insurance companies, and same with resources and mining stocks. So value investing doesn't apply to everything. Just be aware how you pay it. But bottom line, you should never pay more than the company's worth. Okay. Guys, just quick summary. Value investing has proven to be a very successful investment strategy. There are several ways to evaluate its success. You can look at buying, historically looking at buying low PE ratio shares and seeing how they would have performed. You can use the price to cash flow ratio. These are all ratios available on our website. We can also use the low price to net asset value ratio and look at that, do that study. Obviously, the academics have done all these studies already. They have published it. But bottom line, value shares, the value investment approach, has always outperformed the growth investment approach over a long period of time. Okay, so don't try and reinvent the wheel. It's accepted that these guys have done the studies. I believe in having a balance between some growth stocks and value stocks in your portfolio. So it's a nice way to give you that kicker of the growth stocks that, you imagine we had bought Naspers when they were 200 Rand a share or 500 Rand a share. That would be a nice little kicker to your portfolio. Okay, so upcoming events quickly, our webinars for the rest of the month. Next week we're talking about risk management with the 3 S's. I'll talk about the structure, the spread and stop loss. Week after we go back to technical analysis, simple cycle and trend analysis, but very powerful, very basic, very simple, but very, very powerful. And then we come back to fundamental analysis. We're approaching the financial statements. I discuss the income statement and what to look at in that process. Okay. Our coming Traders Forum next week in Pretoria and Centurion. We have our Traders Forum next week, Tuesday, 11th of March. We're talking technical analysis. We're talking about methodology. and then also applying that methodology in a trading strategy. So to be more interactive, those of you in Pretoria, I'm going to change my trading style a bit. I want you guys to interact more, and so we get a little together. To be interesting the way we do it, and I think you find it very, very powerful. The same topic will be covered in Cape Town. Obviously, we can add on to it by then. We are still doing a technical market overview and that kind of stuff. Also, after each Traders Forum, we've changed the format now, where we meet, have drinks and snacks afterwards. The idea is to network, other fellow traders, other fellow investors. Also, opportunity to come talk to me, any suggestions or anything that we can improve, any topics we want to discuss. Okay. Then lastly, obviously, this PowerPoint presentation, the PDF will be emailed to you, as well as the webinar recording. And again, like I do with every webinar, if I can just ask you guys, please go into our Facebook page or our Twitter page and ask questions there. Okay, we have dedicated people that do watch our pages there. I just want to increase the forum. That's the scenario where we can ask more questions that everybody learns. Okay, then obviously use the research tools available on our website. The value and quality filter is a big time saver, as well as the company analysis. We're doing the analysis for you. It's a tool to help you just complement your own analysis, and obviously help you in your confidence. Okay. Look out for our upcoming webinars, upcoming Traders Forum. And just a quick head-ups. I'm planning to have a webinar. We're still deciding if it's going to be a day one or a night one. This is for the more serious investor. This is more for guys looking at offshore. I'm going to be talking about a software program that I like to use. So the topic will be called Value Analytics. It combines fundamentals and technicals together. I'll be having a guest speaker. Some of you might know him, Dr. David Paul. He'll be sitting here with me, and we'll be discussing how this can help you in your analysis of the market and help you make better decisions and obviously make more money using the PSG Line platform. So lastly from my side, good luck and happy trading. There's my contact details. Let me see if there's any other questions that have come through. Okay, Ryan, I've still got a long question. I'll have to come back to you guys. You're asking me 100 questions. Do you trade on the JSE? Yes, Stephen. Do I trade on the JSE? Yes, I do. What is a good amount to make as initial investment? There's a question from Andrew. Great question, Andrew. At PSG Online, we don't have a minimum investment. We obviously must take into consideration your costs. PSG, our minimum brokerage is 98 Rand per trade. So let's use an example. You had to start with 1,000 Rand. Your minimum brokerage is 98 Rand. So as a percentage, your share has to move up 9.8% to break even on costs. We found between 5,000 and 8,000 Rand per transaction, your costs obviously drop down to 1.5% to 2%, and a share can easily make that up in one day and you're in profits. Okay. What's more important is risk management. So you want to spread your risk. You don't put all your eggs in one basket. So, you know, the idea is to maybe, I'm using an example now, take 10,000 Rand, spread 2,500 Rand in each. Your cost then as a percentage drops down to about 3%. So the bigger the transaction, Andrew, the cheaper it becomes. But there's no minimums at PSG. I hope that answers your question. Did Warren Buffett get affected by the stock market crash of 2008? Rosemary, great question. Yes, he did. But obviously he did recover. People also, way back in 2001, I think it was, the NASDAQ bubble, when the NASDAQ was flying through the roof, everybody was criticizing him and saying, no, he was getting to IT stocks, and he ignored it. And obviously we know what happened then. The bubble burst, and then he was smiling because obviously his portfolio didn't take such a big knock. But he's more, as I say, long-term investor. He doesn't worry about crashes and things like that. He buys into good quality stocks, and if there's a crash and the fundamentals of the company hasn't changed, well, his approach is he buys more because the shares are even cheaper now. Yes, I agree with you. This is a question from EJ, Eleanor, I presume. Took 2 years to break even. Buy and hold strategy, yes. I agree. If the stock market does fall, remember the general market falls, that's not with your portfolio. Remember your view is long term. The market will recover. Obviously, the market pulls back. Those companies are still good quality management, good quality companies. They're just trading at lower prices, and that's where it gives you the opportunity to accumulate more at lower prices. So that's where you do more bargain hunting, and that's why it's important to have extra cash. Here's a question from David. Which South African companies shares fall in this group? You also need to go up here. Which South African shares fall in this group? I presume you're talking about value investing. Not 100% sure, but you know, if you go into our website, you go click on research, and you click on the little button called search, and then there's three little shortcuts. I call them defaults. The little button says undervalued quality stocks. That's a value approach. You click on that, it spits out a list of about 20 companies. There's quite a few of them. So offhand, if I remember rightly, and also by the way, we write a bi-monthly newsletter called The Investor, and it's based on this value investing approach. Last week or 2 weeks ago, we wrote about Lewis. A week before that, I think we wrote about Transcap, Transaction Capital. So there's quite a few companies that are undervalued. Saying that, obviously, the market in general, the JSE All Share, is fair value. So we're not cheap at the moment. We're trading quite high PEs, historical PEs, but there are pockets of value. So I hope that answers your question. Okay. There's another question here from Philip. How much time, more or less, will lead to a good investment decision? Well, that's a difficult question. Obviously, it depends on your knowledge and experience. But as I say, if you understand what the financial ratios mean, you click on a button, it spits out a list of undervalued stocks. You already know that these are the stocks I want to look at. So you can do further analysis and determine if it's undervalued or confirm it's undervalued. What you want to do then is obviously also add in your technical analysis to get your timing right. But it takes a few minutes. So it doesn't take hours. The homework's done for you already. There's a question from Graham. What's a good PE in this market? Well, the market at the moment is trading about a PE of 18, 19. So anything lower than that, you're looking at a bargain. You know, I was looking at Sasol. I think it was Sasol. I know they made a new high yesterday, 550 Rand, and that share is still undervalued based on a peg or based on a PE. So to answer your question, I think Sasol is trading on about a 12 or 13 PE. So those are the shares you're looking at. So the average on the market is 18. Anything less than that, you're looking at trading at a discount to that. Ryan. Okay, I've told you already how to gain access to the website. Just go register on the website for a free trial. Then a question from Ryan regarding the filters I mentioned when looking at what stocks to buy. Okay, there's a button that says click on research, click on the search button, and there's an undervalued button. It spits out a list of shares for you. Okay, that doesn't answer your question, Ryan. Just here's my contact number. Just email me when you're in front of your computer, or phone me when you're in front of your computer. I'll explain the process. Okay. Ryan, you asked a lot of questions here. What amount of rands would you need to go offshore? Yes, at PSG, it's a good question, Ryan. Thank you. Offshore investing is not for everybody. Obviously, we do have certain criteria to make it economically viable. With a offshore allowance, we're looking at £5,000. So I'll just use that. Roughly about 80,000 to 90,000 Rand, and also asset swap at least 100,000 Rand. So it's not for everybody. Okay, that's using our offshore investment platform. Thanks for the question. Question from Steve. Do you trade with PSG? Can you trade overseas stock markets? Yes, I just explained now the two ways of looking at it. You can either go offshore allowance, you can take $1 million offshore and without tax clearance, and you can take a further 4 million Rand. Obviously, you do need tax clearance. You can take more than that. We saw with who's our billionaire, can't remember offhand now, but obviously he had a fight with a SARS at the end of the day. You can take more offshore as long as you've got tax clearance. Alternatively is the asset swap, where you keep your money, you don't need tax clearance, you use our asset swap facility, But you can do everything online, open up an account online. If you've got your FICA, it's obviously just easier. But you have to have an offshore allowed account, offshore investment account. Thanks for the question, Stephen. Okay. A question here, but portfolio managed by other asset managers who are regarded as only true value investors. Is this your view true? Not so sure about the approach. I'll have to come back to you, Willie, regarding their approach to the market. I've offhanded now. I've got to talk to my colleagues that are in that area. Okay. Talking about Naspers being a value stock. Yeah, it depends on when you bought them. Right now, I don't see any value in Naspers. It's a growth stock. It's growing, but I won't say it's a value stock. I won't say I'm contradicting. Value, Remgro, also difficult to look at it. Remgro, you have to look at it based on NAV, and usually a company like that does trade at a discount. Doesn't come up on our scan. It's not an undervalued company. But if you had a scan based on NAV and things like that, and looking for companies trading at a discount to NAV, I think that the Remgro might pop up. But I've never regarded as Remgro as a value company. Some people would, obviously, because they're buying to unlisted companies too. I hope that answers your question. I haven't looked at Remgro as such as a value stock. Yeah, could be. Okay. Anyway, guys, thanks for your time. I hope it was beneficial and worth your while. Thanks for spending the time with me. I'm sorry you went a bit overboard with all the questions. If I didn't answer your question, I'll be coming back to you by email. Okay. But from my side, just remember, here's my little disclaimer. None of these, whatever I said in this presentation, can be construed as investment advice. Please understand this is just for training purposes. So just take it as it is. I hope you found it useful. Thanks for your time. We'll talk to you guys again. All the best. Bye-bye.